Welcome to the Market Pulse Desk, where we analyze public economic indicators, sector rotation data, and historical patterns to provide educational insights on the markets. Today, we're exploring a critical issue that affects millions of households: the gap between official inflation metrics and the real cost of living, and what this means for your financial future. Let's start with the uncomfortable truth: the inflation rate you hear on the news, what the government reports through the Consumer Price Index, may not actually reflect what you're experiencing at the grocery store, gas pump, or when paying your mortgage. Research shows that the current inflation rate, as measured by the Consumer Price Index, CPI, may not accurately capture the prices consumers are actually paying for goods and services. According to the Bureau of Labor Statistics, BLS, the CPI has risen by 4% over the past year. On the surface, that sounds manageable, but here's where it gets concerning. Our analysis of granular economic data suggests that this headline figure may not capture the full extent of inflation that everyday Americans are experiencing. Why? Because inflation isn't uniform across all sectors of the economy. Let's examine some specific examples. Housing costs, arguably the largest expense for most households, have increased by 4% over the past year, according to the S&P CoreLogic Case-Shiller Home Price Index. That's nearly double the official inflation rate. For a family with a $300,000 home value, this represents an additional $31,200 in theoretical wealth or debt, depending on your perspective. But for renters, it's different. Median rent prices have surged by 8–12% in major metropolitan areas, with some cities like Austin, Denver, and Miami experiencing increases exceeding 15% year over year. Consider the case of Sarah, a 45-year-old teacher in San Francisco earning $75,000 annually. 5 years ago, she could comfortably afford a one-bedroom apartment for $2,000 per month. Today, that same apartment rents for $3,200, a 60% increase over 5 years, while her salary has only grown by 12%. This is the hidden inflation trap in action. Healthcare presents another startling picture. Healthcare costs have increased by approximately 5% annually over the past decade, consistently outpacing overall inflation. For someone with a chronic condition requiring regular medication and specialist visits, the true inflation rate they experience might be 7–9% annually. The Kaiser Family Foundation reports that family health insurance premiums have grown 55% over the past decade, while wages have grown only 26%. Beyond housing and healthcare, let's examine grocery prices. While the CPI suggests food inflation of around 5%, specific categories tell a different story. Beef prices have risen 15%, dairy products 12%, and cooking oils 20% in recent years. Families who buy organic products, specialty items, or shop in areas with limited grocery competition may experience food inflation rates of 6–8% annually. This discrepancy between official inflation metrics and actual consumer prices has significant implications for investors and consumers alike. The IRS publication confirms that inflation can erode the purchasing power of consumers, particularly those on fixed incomes. Let me illustrate this with actual numbers. A retiree receiving a $4,000 annual pension may see its real value decline by $2,000 to $2,400 annually if they are experiencing inflation rates of 5–6%. While the official CPI suggests only 3–4%. The Federal Reserve survey shows that many households are not adequately prepared for the consequences of inflation, highlighting the need for proactive planning and investment strategies. In fact, a 2023 survey found that 58% of Americans reported that inflation had negatively impacted their ability to save and invest, and 43% reported reducing their investment contributions due to higher living costs. We analyzed data from various sources, including the Federal Reserve, the Bureau of Labor Statistics, and the IRS, to provide a comprehensive understanding of this issue. The consensus is clear. There's a meaningful gap between headline inflation and what economists call sticky inflation in essential categories. Now, What does this mean for your investment strategy? With the S&P 500 averaging around 10% nominal returns over the long term, investors need to be aware of the potential impact of inflation on their portfolios. Let's break this down. If you're earning a 7% return on your investment but experiencing real inflation of 6%, your actual purchasing power gain is only 1%. This is why understanding true inflation rates is crucial for portfolio construction. Historical recession data provides valuable insights. The average recession duration post-World War II has been approximately 11 months, but recoveries vary significantly. More importantly, sector rotation data indicates that utilities have outperformed in the last 3 recessions: 2001, 2008-2009, and 2020, with defensive sectors like consumer staples and healthcare also providing downside protection. Let's examine a concrete case study. Imagine a household earning $50,000 per year with a typical 3% annual increase in income. If inflation in their actual cost categories rises by 5% over the same period, perhaps 10% in housing, 8% in healthcare, 3% in food, and 2% in other categories, their household's purchasing power will be significantly reduced. Their 3% raise effectively becomes a negative 2% real return. This is why strategic financial planning that accounts for sector-specific inflation is essential. Sector rotation becomes critical in this environment. During the 2008 financial crisis, utilities outperformed the broader market by 15%. During the 2001 recession, consumer staples significantly outperformed growth stocks. This pattern suggests that in inflationary environments with economic uncertainty, rotating toward defensive sectors can protect both capital and purchasing power. What about energy and commodities? Oil prices, which directly influence transportation and production costs throughout the economy, can swing dramatically. A $1.10 increase in crude oil prices adds approximately $0.25 per gallon at the pump, seemingly small until you calculate annual impact for a household driving 12,000 miles annually, which adds roughly $300-400 to annual expenses. According to BLS data, the CPI has fluctuated significantly over the past decade. We saw 3% inflation in 2020 and 4% in 2019, but these headline numbers mask substantial sectoral variations. These fluctuations underscore the need for a nuanced understanding of inflation and its effects on consumer prices. By analyzing these trends and patterns, we can develop a more informed approach to investment and financial planning. Consider diversifying your portfolio across sectors that perform differently under various inflation scenarios. Include inflation-protected securities, dividend-paying stocks in defensive sectors, and real assets like real estate or commodity exposure. As we conclude our analysis, it's essential to remember that markets reward the patient and the prepared. Understanding the hidden inflation trap, the gap between official metrics and your actual cost of living, is fundamental to long-term financial success. With the right knowledge and strategies, individuals can navigate the challenges posed by inflation and achieve long-term financial success. If this information has helped you better understand the hidden inflation trap and its implications for your financial future, hit subscribe for more educational content on the markets and investing. We're covering the topic of navigating market volatility in our next video, dropping on Friday. Ring the bell so you don't miss it. What's your biggest takeaway from this video? Share your experiences in the comments.